On May 6, 2006, Warren Buffett and his business partner Charlie Munger hosted their annual Berkshire Conference in Omaha, Nebraska. At the time, home prices were in a massive bubble, having appreciated 84% in 6 short years. The market was raging and everyone was wondering what would happen next. Talking to a crowd of 21,000, Warren Buffett was asked the following question.
What are your thoughts about the residential real estate market in the U.S., where it's headed, and how is California different, if so?
What happened next, we of course know in hindsight. This was the very top of the 2000s housing market. That summer, home prices would begin their record-breaking collapse, falling 28% nationwide and as much as 61% in cities like Las Vegas. It would become known as the subprime crises, one of the biggest financial meltdowns in history. For the first time since the Great Depression, home values collapsed across America. We look back at this event today with plenty of assumptions about the lead-up, but if you talk to anyone that lived through the bubble, the 2007 crash was truly believed to be an impossible scenario. Generations of Americans had never experienced anything remotely close to what would eventually unfold in the years following the conference and this question. Today, this same scenario could be playing out as we speak. New evidence is emerging that seems to point to a coming crisis, and the warnings Warren was calling out in 2006 sound eerily similar to the scenario playing out today. Take a listen to how he answered that question I just showed earlier, and keep in mind this is happening right here in the timeline, quite literally months or even days before the big crash began.
From time to time, even in great localities, you've seen it happen in New York a couple of times, in the last 30 years, where the swing in properties values has just been huge. And what we see in our residential brokerage business, and we're in I don't know how many different states, is we see a slowdown every place. Now we see it most dramatically in some of what have been the hottest markets. And the markets where you're going to, in my view, you're likely to see the greatest fall off and where you've had the biggest bubble are the ones tend to be the high-end market, and they tend to be ones where people have bought for investment or speculation rather than use.
So that's the first part of his infamous answer, and if we look today at where those places are, it's nearly identical. Let's just take a look at Florida, where word for word this is happening. A condo in Fort Lauderdale would cost you around $312,000 in the summer of 2020, and just 3 years later it was $453,000. And of course, this is just the average condo. I'm not even looking into the high-end market where the bubble was even more pronounced. Now dig a little deeper and you see that a large reason for this massive increase in values is investor speculation. For example, according to Realtor.com, in 2024, 17% of all homes bought in the Fort Lauderdale, Miami area went to an investor and not an individual or family. Looking at their chart for investor activity in general, you can easily see the massive spike in activity starting in 2021 and ending in 2023. So much was built up in here, and overall the trend line has grown nearly 3x from the days of 2006. Today, investment and speculation is a much bigger part of the market than it was back then, which begs the question, are we in a more dangerous situation today? Investors are unlike regular buyers. They are obviously in it for the money, and values do matter to them. On the other hand, a family, as long as they can pay for the mortgage, will keep their house or condo irrespective of the value, even if it's declining. This is the kind of market behavior that Warren warns us about when he talks about the big price swings. When too many investors pile in, it creates the setup for sharp declines. Once prices start falling, investors rush to undercut each other just to stay afloat, triggering a self-reinforcing loop that drives values even lower. Listen to him explain it. It sounds eerily similar to what's happening today.
When you have investment type holdings or speculation type holdings, when you in effect have had the day traders, of the internet move into the day trading of condos, then you get a market that can move in a big way. First it sort of stops, and then it kind of reopens. real estate is different than stocks. If you own 100 shares of General Motors, it's going to trade on Monday, and that's what it's worth, and you can't kid yourself about it. But if you own real estate, there's a great tendency to think about the one that sold down the street a few months ago. And there's a great tendency to think, you only need one buyer who hasn't gotten the word that things have slowed down, and you'll make your sale. I can tell you that in Dade and Broward County, for example, in Florida, where the average condo is about $500,000, if you go back to December of 2004, there were less than 9,000 condos listed for sale, and I think 2,900 of them sold in the month. So you were turnover one every 3 months, less than that. Now the listings are up to 30,000, and the sales are down to under 2,000 a month. Well, 30,000 is $15 billion worth of properties, and you were very likely, you can get real discontinuities in a market like that, where all of a sudden people realize that the whole supply-demand situation has changed. So I think we've had a bubble to some degree, and it's very hard to measure that degree till after it's all over. But I would be surprised if there aren't some significant downward adjustments from the peak, particularly in the higher end properties.
So as you just heard him explain, the scenario is clear. Investors become a large share of the market. There's a downturn, the downturn turns into a spiral, and you have a moment where everything sort of pauses and comes down all at once. According to Zillow's numbers, a typical condo in Fort Lauderdale has gone from $458,000 in the summer of 2023 to $415,000 just 2 years later. Right now, we're only down about 10%, roughly 5% a year, but the drop is accelerating fast. Remember, even the 2008 crash didn't happen in a straight line. It played out over several years. The pace we're seeing in Florida today looks strikingly similar, and unless there's some relief or a rebound in values, which there's no evidence for, this decline will keep deepening. A 20 to 30% fall over the next few years is a very real possibility. History tends to repeat itself, and of course, in the Florida condo market, that same exact situation from 2006 is unfolding again. Inventory, which is the biggest tell in housing, is continuing to flash red, signaling that it's only going to get worse from here. In many Florida markets, months of supply has already climbed to 2008 level territory, with several communities surpassing double digits. According to the New York Times, the number of active listings in the state has tripled since 2022 and continues to rise. Just as in 2008, what began as a downturn in Florida's condo market eventually spread nationwide, and today we may be watching the same pattern unfold again. Thank you guys for watching. As always, please make sure you hit that like and subscribe button if you enjoyed it, and let me know what you think of Warren's comments from 2006 and if they apply to the situation unfolding in the market today.